A new horizon for reporting. Introducing IFRS S1 and S2. Today, on May 21, 2026, the global business landscape is being reshaped by a powerful force: the demand for transparent and reliable sustainability reporting. At the forefront of this evolution are the new standards from the International Sustainability Standards Board, the ISSB. These standards, known as IFRS S1 and IFRS S2, are not just another set of compliance hurdles. They represent a fundamental shift in how companies communicate their value and resilience to investors, regulators, and other stakeholders. For the insurance industry, which stands at the nexus of financial services and real-world risk, understanding and implementing these standards is not merely an option. It is a strategic imperative for long-term viability and trust. IFRS S1, titled General Requirements for Disclosure of Sustainability-Related Financial Information, provides a foundational framework. It requires companies to disclose comprehensive information about all significant sustainability-related risks and opportunities they face. This standard ensures that investors receive a complete picture of how sustainability matters could reasonably be expected to affect a company's cash flows, access to finance, cost of capital over the short term, medium term, long term. It is the bedrock upon which more specific disclosures are built, creating a consistent language for sustainability reporting that transcends industries and geographies. It encourages a holistic view, linking sustainability performance directly to financial prospects and enterprise value. IFRS S2, its more focused counterpart, deals specifically with climate-related disclosures. This standard is particularly critical for insurers, given their direct exposure to the physical risks, transition risks associated with climate change. IFRS S2 mandates detailed reporting on climate-related risks and opportunities, covering 4 key areas: governance, strategy, risk management, metrics, and targets. Companies must explain how their board and management oversee climate issues, how climate change impacts their business model and strategy, how they identify and manage climate risks, and what data they use to measure their performance and progress toward climate-related goals. This level of detail aims to give investors the clarity they need to make informed decisions. The importance of these standards for the insurance sector cannot be overstated. Insurers are unique because they face risks on both sides of their balance sheet. Their investment portfolios are exposed to the transition risks of a decarbonizing economy, while their underwriting activities are directly impacted by the physical risks of a changing climate, such as more frequent and severe storms, floods, and wildfires. Consequently, failing to adequately report on these matters can erode investor confidence, attract regulatory scrutiny, and damage brand reputation. Conversely, robust and transparent reporting in line with IFRS S1 and S2 can become a powerful differentiator, demonstrating a firm's sophisticated risk management capabilities and its proactive stance on building a resilient future. Imagine a modern office building with a green leaf logo, symbolizing the intersection of finance and sustainability. The core of S1 and S2, what insurers must disclose. To effectively apply IFRS S1 and S2, insurers must grasp the core disclosure requirements that form the heart of these standards. The framework is designed to elicit information that is material decision useful, directly connected to financial reporting. For an insurer in a market like Nigeria, this means translating broad principles into specific disclosures that reflect local realities: exposure to coastal flooding, agricultural disruptions from drought. The information required is structured around 4 pillars consistent across both S1 and S2: governance strategy, risk management metrics, and targets. The governance pillar demands transparency regarding the institutional structures in place to oversee sustainability matters. Insurers must describe the board's oversight of sustainability-related risks and opportunities, and detail management's role in assessing and managing them. For example, an insurer would need to explain if it has a dedicated board committee for sustainability, how often that committee meets, what expertise its members possess. It would also need to clarify how executive compensation is linked to achieving sustainability targets.
Under the strategy pillar, insurers are required to articulate how sustainability and climate-related issues impact their business model strategy, financial planning. This includes disclosing the identified risks and opportunities over the short term, medium term, long term. A key component here is the use of scenario analysis, particularly for climate risk under IFRS S2.
A Nigerian insurer might model the impact of a 2-degree Celsius warming scenario on its property insurance portfolio, estimating the potential increase in claims from rising sea levels in Lagos. The strategy disclosure must also cover the company's plans for adapting to these risks and capitalizing on opportunities, such as developing new insurance products for renewable energy projects. The risk management pillar focuses on the processes used to identify, assess, and manage sustainability-related risks. Insurers must explain how these processes are integrated into their overall enterprise risk management, the ERM, framework. This is a natural fit for the insurance industry, which already possesses sophisticated risk management expertise. The disclosure should detail the methodologies used, such as risk mapping tools, internal models for quantifying climate risk. For instance, an insurer would describe how it uses catastrophe models to assess physical risks and how it evaluates the transition risk within its investment portfolio, such as holdings in fossil fuel-dependent industries. This section provides assurance that the company is not just aware of the risks, but has a systematic approach to handling them.
Session 1. The Auditor's Lens on Sustainability Data.
As sustainability disclosures become integral to corporate reporting, the role of the auditor expands to provide assurance on this new class of information. This process is crucial for building the trust that investors and regulators place in IFRS S1 and S2 reports. Assurance on sustainability data is still an evolving practice, but it typically falls into 2 categories: reasonable assurance, limited assurance. Reasonable assurance is the higher level, akin to the standard audit of financial statements. It provides a high degree of confidence that the information is free from material misstatement. Limited assurance, on the other hand, provides a lower level of confidence and involves less extensive procedures, concluding that nothing has come to the auditor's attention to suggest the information is materially misstated. For auditors to provide reasonable assurance on an insurer's sustainability report, they must undertake a comprehensive and rigorous set of tasks. This process goes far beyond a simple check of the final numbers. First, the auditor must meticulously plan the engagement, understanding the insurer's business, identifying key sustainability metrics, setting materiality thresholds. A significant part of this involves assessing the risk of misstatement for each disclosure. For example, forward-looking data from climate models would be considered higher risk than historical data on energy consumption. The next phase involves detailed testing of both the data and the underlying systems and controls. Auditors must check the sources of the sustainability data, third-party climate model outputs, internal operational records. They will test the internal controls the insurer has implemented to ensure data accuracy, completeness, integrity. This could involve recalculating a sample of key metrics, such as the carbon footprint of the investment portfolio, or tracing data from its origin to the final report. The auditor will also critically evaluate the assumptions and estimates made by management, such as the discount rates used in scenario analysis, to look for potential bias or error. Finally, the auditor must form a conclusion and issue a clear report. This report will state the scope of the work the standards followed and the level of assurance being provided, whether reasonable or limited. For specialized areas like climate science, the audit team may need to engage its own experts to challenge the insurer's methodologies and assumptions effectively. The evidence gathered throughout the process, management interviews, system walkthroughs, data recalculations must be meticulously documented in the work papers. This documentation serves as the basis for the audit opinion and is essential for demonstrating the quality and rigor of the assurance work performed.
Section 4. Session 2. Navigating the regulatory landscape in Nigeria.
For insurers operating in Nigeria and similar emerging markets, complying with IFRS S1 and S2 is not just about following international best practices. It is also about meeting the growing expectations of national regulators. The National Insurance Commission, NAICOM, in Nigeria, like its counterparts globally, is increasingly focused on the financial stability implications of climate and other sustainability risks. As these standards become the global baseline, regulators will expect local insurers to adopt them to ensure a level playing field and to safeguard the stability of the financial system. They will be looking for clear, reliable, and comparable disclosures that demonstrate a firm grasp of these complex risks. Regulators like NAICOM will have a specific checklist of items they will scrutinize in an insurer's sustainability report. First and foremost, they will demand clear disclosure of the material climate risks affecting the insurer's underwriting portfolios, material climate risks affecting investment assets. This includes evidence that the company has performed robust stress testing and scenario analysis to quantify its potential exposures. Second, regulators will want to see concrete plans for managing transition risks, policy changes affecting carbon-intensive investments, and physical risks, increased claims from extreme weather. Third, they will closely examine the governance disclosures to ensure that the board has clear oversight and senior management has clear accountability for sustainability matters. In the near future, Nigerian insurers should anticipate several regulatory developments related to sustainability reporting. It is highly probable that NAICOM will issue specific guidance on the implementation of IFRS S1 and S2, potentially including timelines for mandatory adoption and specifying the required level of assurance. We may also see the introduction of industry-specific templates or metrics to promote consistency and comparability across the Nigerian insurance market. Furthermore, as regional and continental bodies push for economic integration, there will be increasing pressure to harmonize sustainability reporting rules across West Africa and the wider continent, making early adoption a strategic advantage for forward-thinking firms. To prepare for these changes, Nigerian insurers can take several practical steps. Moving on.
Section 5, Session 3, a practical action plan for implementation.
Adopting IFRS S1 and S2 can seem monumental, but a structured, phased approach makes it manageable. A clear action plan builds momentum and allocates resources efficiently, avoiding last-minute scrambling. The journey begins with understanding the current state, then building capabilities, systems, and processes, and culminates in a high-quality, assurance-ready report. The plan is 5 logical steps with suggested timelines. Step 1. Quick assessment. Complete within the first 4 weeks. Goal: get a high-level view of the company's position. Identify significant sustainability and climate risks and opportunities. Claims data, underwriting policies, investment portfolios. Conduct a gap analysis against IFRS S1 and S2 requirements. Use this to form the detailed project plan and resource allocation. Step 2. Team and governance. Overlaps week 4 to week 8. Require clear leadership and cross-functional collaboration. Assign a project lead or champion. Form a small, empowered team. Risk, finance, underwriting, investments, legal. Define the board's oversight and reporting lines. Integrate sustainability into the board agenda and decisions. Step 3. Data and systems. Week 8 to week 20. Build the technical backbone of the project. Identify key data points required for disclosures. Design or enhance systems to collect and store information. Invest in new software or adapt existing platforms. Implement robust internal controls and audit trails. Pilot climate scenario analysis methodologies. Step 4. Assurance readiness. Week 20 to week 32. Engage external auditors early. Agree scope, limited. Agree scope, reasonable. Run a dry run or mock assurance review to find gaps. Step 5. Report and improve. Begins around week 32 and is ongoing. Prepare and publish the first compliant report. Solicit feedback from investors and stakeholders. Use lessons to refine and enhance the process for next year. That's the roadmap.
Section 6, Conclusion, Embracing Change and Building Trust.
The introduction of IFRS S1 and S2 marks a significant turning point in corporate reporting, elevating sustainability from a niche concern to a core component of enterprise value. For the insurance industry, these standards are not an administrative burden, but a powerful opportunity. They provide a globally recognized framework for demonstrating how well a firm understands and manages the profound risks and opportunities emerging from climate change, other sustainability trends. By embracing this change, insurers can strengthen their risk management, enhance their strategic planning, and most importantly, build deeper and more enduring trust. Investors, regulators, customers. The journey toward full compliance requires a deliberate and methodical approach. The process should begin now with a clear-eyed assessment of current capabilities and a structured plan for closing the gaps. Establish strong governance from the top, build cross-functional teams, invest in the data and systems necessary for robust reporting. Engage early and often with auditors, engage early and often with regulators. This proactive collaboration helps de-risk implementation and align disclosures with market and supervisory expectations. The practical action plan provides a clear pathway. It breaks down a complex undertaking into manageable phases. Initial assessment, team building, data system, development, assurance readiness. By following these steps, insurers in Nigeria and beyond can navigate implementation with confidence and clarity. Start immediately, maintain momentum. View this as the beginning of a continuous cycle of measurement, reporting, improvement. The world is changing and corporate accountability standards are changing with it. IFRS S1 and S2 are about communication and confidence. They equip insurers with the language to tell a clear and compelling story about resilience and long-term strategy in a rapidly evolving world. Insurers that master this language will not only achieve compliance, but will also gain a distinct competitive advantage. Better understood by capital markets, better prepared for regulatory oversight, better positioned to thrive in the sustainable economy of the future. The time to act is now. The path forward is clear, and the rewards for those who lead the way will be substantial and lasting. That's it.